Sometimes a stock doesn't just dip. It completely and utterly collapses. And when that happens, it leaves behind a trail of digital evidence. So today we're going on a forensic investigation. We're going to sift through the data and figure out exactly how a stock can get so totally wiped out in such a short time. Let's open the case file.
So, let's start with the number at the absolute heart of this investigation, negative 92.57%. Just let that sink in. That's a figure that represents a total, catastrophic failure.
That's what investors in a company called PAVS saw on December 1st, 2025. It's an almost unbelievable evaporation of money, all in a single trading session.
Okay, so here are the basic facts of the case. The ticker symbol is PAVS, trading on the NASDAQ. The event, as we know, was a one-day collapse. But here's the real kicker, the key piece of evidence. Look at that volume. Over 304 times million shares changed hands. That is a staggering number. This wasn't some quiet slip. This was a market-wide stampede for the exits, a collective panic you can actually see in the data.
So that brings us to the big question, right? The one we're trying to answer here. How does this even happen? What kind of perfect storm of conditions leads to a financial event this extreme?
Well, to find the answer, we've got to put on our detective hats. We're going to follow the clues, and they're all hidden right there inside the technical data. Each little indicator tells us a part of the story, another piece of this very big, very ugly puzzle.
All right, clue number one. We need to look at the stock's health before the day of the crash. Was the victim already sick? We're examining the pre-existing conditions, starting with the overall trend.
And wow, just look at this comparison. It's staggering. The current price was less than 8 cents, but its average price over the last 200 days was almost $1. The gap between those two numbers is just enormous. This tells us the stock wasn't healthy at all. It had been sick and in a state of decline for a very long time.
Now, that 200-day number, that's what's known as a moving average. The easiest way to think about these is like a long-term EKG for a stock. They just smooth out all the day-to-day noise so you can see the real underlying direction the price has been headed. And get this, analysts actually have a score for this kind of thing. It's called the Moving Average Alignment Score. And the score for PAVS? A perfect, and I mean that in the worst way, -3. Let me be crystal clear here. A score of -3 isn't just bad. It is the worst possible score you can get. It means that across every single important time frame, short, medium, and long term, the entire market was in complete agreement. There were no holdouts, zero signs of optimism. Every single signal was pointing straight down. So our first clue is a big one. PAVS was already in a confirmed, powerful freefall long before that final catastrophic day. Okay, so we've established the stock was already sick, already falling. Clue number 2 is all about measuring the force of that fall. Just how fast and how hard was this thing actually crashing? It's time to talk about downward momentum.
Our first piece of momentum evidence is from the RSI, the Relative Strength Index. It's sitting at 31.76. Now, for the RSI, the magic number is usually 30. Anything below that, and you're in what's called oversold territory, which basically means the selling has gotten pretty extreme. So this tells us we are right on the cliff's edge of that zone.
But one indicator isn't enough, right? So let's look at another one, the Williams %R. This one gives us a reading of -98.38. This scale only goes from 0 to -100. So to be this close to -100, well, that's a powerful, independent confirmation that this isn't just regular selling. This thing is deeply, deeply oversold.
And then we get to the final piece of momentum evidence, the stochastic RSI. And folks, the reading here is 0. Literally 0.0000. It does not go any lower than that. This is the technical equivalent of a flat line.
The source report we're looking at puts it perfectly. A reading of 0 indicates the price is closed at the absolute bottom of its recent range. In other words, at this exact moment, the selling pressure was total. There was nobody left, not a single person, willing to buy at a higher price within its recent history. Clue number 2 is undeniable. The downward force wasn't just strong, it was absolute.
All right, so the trend was down, momentum was completely bottomed out. So for our third and final clue, we need to figure out just how wild this single day really was. Just how far off the charts did this crash actually go? We're now assessing the extreme volatility. Now this number might be the weirdest one yet. It's the Bollinger Band position,
and it's negative 25.98. Just to give you some perspective, almost all of the price action for a stock, like 95% of it, is supposed to happen between +2 and -2 on this scale.
Which, leads to the pretty obvious question. What in the world does a number like -26 even mean in that context?
It means the price has moved so far, so fast, that it's in a zone of extreme statistical improbability. Look, if the normal range for a stock is a highway, this event isn't just in the breakdown lane. It's miles off the road, deep in the woods, in totally uncharted territory. It is completely and literally off the map.
Okay, we've gathered all our clues. The trend, the momentum, the volatility. It's time to step back, piece it all together, and deliver the final verdict.
And when you lay it all out, the case is just overwhelming. Let's recap. First, we proved the stock was already in a strong, established downtrend. Second, the negative momentum was completely maxed out, with indicator after indicator screaming oversold. And finally, the price drop itself was a historic volatility event, a truly massive statistical deviation.
So, case closed, right? A complete and total technical breakdown. But is that really the end of the story?
Well, not quite. And this is where it gets really interesting. The very same signals that are screaming disaster, those deeply oversold readings we saw, they actually have a second, more subtle meaning. They're a sign of capitulation. They hint that the selling pressure, as insane as it was, might just be temporarily exhausted. It's like a fire that's burned through all the available fuel. The sellers may have simply run out of steam.
And that leaves us with this one last, really challenging question to think about. The damage is done, the verdict is in, but the data hints that a pause might be possible. It makes you wonder, when a stock has been this completely and utterly broken, what does the very first step back from the brink even look like?